Well, today we'll talk about industry momentum. Here is the definition of it. This strategy focuses on the return data of 30 industries and its market return to analyze the scenario. Firstly, after calculating and ranking, we find that electricity equipment has the highest average rank, which is 17.17, and telephone communication has the lowest rank, which is 14.08. From the rank of autos industry, it seems like a dramatic fluctuation. And then from the graph of volatility, we find that they all move in a dynamic strategy. The turnover should be high because we adjust frequently and sometimes pay extra commission charges. Then we will talk about winner and loser portfolio. From this table, we knew all of the data. And we find that, winner portfolio outperforms the market and loser portfolio because it is the largest analyzed Sharpe ratio. However, the loser portfolio underperforms the market because it is the lowest analyzed Sharpe ratio than the market. Then we will talk about long-short industry momentum. From this table, we know that the analyzed Sharpe ratio of the long-short industry momentum is 0.61. It means that when risk grows by 1 unit, the excess return rises by 0.61 annualized. It is outperforms the market. From this table, we knew that the market beta is negative 0.06. It represents the sensitivity and systematic risk. And the absolute value of T statistic of it is larger than 2, so it is significantly different from 0 at 5% significant level. And from the table, we know that the monthly alpha is 0.0049, and the T statistic of the alpha is definitely larger than 2, so it is significant different from 0. And we knew that the analyzed alpha is 5.84%. From the graph of cumulative return, we find that the full portfolio shares the same return and grows a lot during those years. The winner portfolio performs best, where loser portfolio represents the worst. Then we will talk about the loss in industry momentum. We found that was a big loss from March to May in 2009 from a social level. After a great financial crisis in 2008, the financial market was in the recovery stage. The market excess return performed well, but why the portfolio performed terrible? Firstly, there was a market rebound in the beginning of 2009. It causes loser portfolio to perform well immediately, where initial winners could not adjust rapidly, so it may cause some losses. In addition, we found that during the financial crisis, some industry in winner portfolio had a lower risk, while some industries in loser portfolio had a higher risk. In the beginning of 2009, the U.S. bailout actions such as quantitative easing, which can improve the investors' confidence. So, during that period, the portfolio had a higher rate with a higher risk. More investments performed to get more return, so they would short more. Lastly, we will talk about the best strategy. The best strategy performs well when there has the largest analyzed Sharpe ratio, as it can represent they can get more excess return under the same rate. And firstly, we assume that the rank of N is from 1 to 15 and calculate each analyzed Sharpe ratio of industry momentum. Through calculation, analyzed Sharpe ratio peaks when N is equal to 12, which represents the best strategy. Then we will conclusion. And after analyze industry momentum, we find that it can help achieve higher investment returns and effectively managing risks. Also, it teaches investors to change invest strategies when facing different financial situations. Thanks for listening.